now that we've looked at a balance sheet and we've talked about conceptually what a balance sheet is, it's important that we talk about why people would use a balance sheet. Why do investors or analysts, why do they even care? And so one reason that is an important tool is that it allows us to calculate various rates of return. And we're thinking about return, we're thinking about things like return on equity and return on assets. Right? To do that, we're going to need to know these asset account totals, equity account totals. Now, why do we even care about this? Well, let's think about this. So you're an investor, and you invest in a company, and then the company says, you know what, we made $100 profit. $100 profit. Now, you might say, hey, that's great. That's great. And then you have another company that you invested in, and they also have $100 profit. And you might say, well, hey, both companies are doing great, but what if one of them had assets of $1,000 and then the other one had assets of $100,000? Now, doesn't that make a difference? That's why we want to take a look and say, okay, you made $100 profit, but how many assets did it take you to do that? How much equity did you have? We want to look at the return against something. We want to say the return on equity, the return on assets. And so when we calculate these rates of return, we can use these balance sheet items to do that. And so another reason we might look at a balance sheet is we think about this idea of capital structure of the firm. And remember that, so we've got with the firm, we've got assets, and then we've got claims against these assets, right? We've got liabilities, right? We might be lenders and things like that. And then we've got stockholders' equity or owner's equity, the owner's claims against the assets. So we've kind of got borrowers' claims against the assets, and then we have equity holders' claims against the assets. And we can use balance sheet items to kind of see, well, how does this all shake out? Is this firm mostly financed by debt? Do we look and see that, wow, this is a really highly leveraged firm? Or does this firm have equity holders have a much higher stake? When we think about the capital structure of the firm and what it might entail, we can look at the balance sheet items to kind of infer some of these things that we want to know. And then also liquidity is a very important thing. And when we think about liquidity, what we're really talking about is can this firm pay its bills? Does it have cash right now? How liquid are its assets? When we think about liquid, so let's say there's a firm with a lot of accounts receivable, and then you have another firm with a lot of assets like intangible assets or things like goodwill. Well, a firm with a lot more of these current assets, things like accounts receivable, is going to be a lot more liquid, and you can actually compute some more ratios. Similar to how you've got this return on equity, return on assets. Well, there are liquidity ratios that we can look at that give us a good idea. Instead of having to compare accounts receivable to goodwill or these different things, we can just say, okay, well, what's the firm's current ratio? What's the firm's quick ratio? We have all these different ratios, which basically give us an idea of how liquid this firm is. Can it pay the commitments that are going to come due in the next few months? Does it have cash right now to pay out a dividend? And we can kind of compare firms when we compute these ratios and tell how liquid they are. And solvency is kind of, I guess, we can think about in terms of liquidity. It's not all that different, except more now we're thinking about on a long-term basis. So this firm is going to have obligations that come due, assuming it has debt. Can this firm pay its bills as they mature? Can it pay its interest? Is this firm is it too loaded down with debt that it can't even function? That this firm, okay, 5 years from now, this firm is just going to sink under its debt level. How solvent is this firm? Is it going to declare bankruptcy in the next 4 years? And so we're not really thinking in the short term like liquidity, where we're thinking about these ratios and can the firm pay a dividend or can it handle its accounts receivable it has right now. We're looking at the long term and saying, okay, is it even sustainable with the level of debt that this firm will even exist in 5 years? Now, when we think about like the balance sheet versus the income statement, so balance sheet versus the income statement, now people tend to focus on the income statement. Right, analysts and stuff, because what they care about is earnings. They want to look at earnings and say, well, where earnings? Did the firm make its earnings and stuff? Well, with the balance sheet, we think, okay, well, maybe the balance sheet isn't that important. Well, if we think about the firm in terms of its health and how well the firm is doing, is it good or bad? So let's say the firm is doing good. Well, maybe we are just saying, okay, well, we're not as concerned with the balance sheet. We're thinking about earnings. But when the firm is doing poorly, now we might all this idea of solvency and these things come into play and liquidity, and we say, okay, well, I want to take a look at the balance sheet. I don't care. We know the firm is losing money. Things are going poorly. I want to look at the balance sheet, and I want to see how much cash are we going to. Does this firm have a bunch of goodwill that if the firm goes to bankruptcy court, we're not going to be able to get anything for that? Or does it have buildings that maybe in a bankruptcy proceeding, maybe we could liquidate those and sell them at auction and get some money for it? So there's kind of this idea that when the firm is doing well, the income statement is kind of maybe a higher priority or something people think about. But as soon as a firm starts having financial problems, people start looking toward the balance sheet to say, okay, how much can be salvaged if this firm goes bankrupt?